VA assumptions. They are possible. They are possible with vets and with non-vets, and there's definitely some details that you need to know. Before we get started though, I need you to like this video, share it out to those friends and family who are vets, and also subscribe to my YouTube channel. So let's talk. VA loans can be assumed. An assumption means a new person takes over the current loan terms. The cost is not very expensive, $300 to $500. The time that it takes is a good 60 days, sometimes 45, to get an assumption complete. And it can either be a simple assumption or a full assumption. The important thing to know with VA is that unless your buyer is a veteran, they are not assuming that loan with a full assumption. They cannot. The only type of full assumption that can be done is with VA to VA. So vet to vet, or active duty persons that is in the military. So let's break that down a little bit more. So if you have a home that you're selling for $350,000, let's say that there's an existing loan for $300,000 and an interest rate of 2.75%, and there's 25 years left on that loan. Someone can come along and assume that loan and take those payments over and have that 2.75 interest rate, 25 years left on their loan, and have that loan assumed. If they're a VA, a veteran, or have VA eligibility, they can do a full assumption and take over all the required payments. They have to still apply, be credit worthy and debt to income ratio worthy. So they have to apply similar to what they would do with a loan officer, directly to the mortgage servicer. So directly to who that person makes the payments to. Well, what happens if you are a non-vet and you want to take that loan over? Well, if you are not a veteran and you want to assume that loan, you can, but it's a simple assumption. That means that that borrower, the initial borrower, is still responsible for that mortgage ultimately. So what that means is their eligibility, for their VA eligibility, remains on that property. And so if, God forbid, there was a foreclosure, that veteran would be responsible for that mortgage and lose their eligibility for a certain length of time. Well, so if you are a veteran and you want to allow for an assumption, you really need to vet that buyer well. Make sure they have good credit, make sure they have stability, make sure they have good income and assets, and make sure that they are reliable. If you know them personally, that definitely helps for sure. So I have two coworkers that did something like that, and I helped them through the process, and that worked out beautifully. And they knew each other, and they both had outstanding credit, and they were both very reliable individuals. So if you decide to go that route and you do that simple assumption, well, what happens is you lose some of your eligibility. However, you have what's called a second eligibility. That means, this was established in around the mortgage meltdown around 2008 or so about 15 years ago. A second eligibility means that you can still buy a home as little as $0 down on a second VA loan if your sale price is greater than $144,000, and then to the max capacity that your debt ratio would allow, or that and your disposable income. So it's a multi-calculation. So for example, I have the Harrisons that are eligible to do a second eligibility from $0 down up to, so $144,000 purchase price, up to a purchase price of $500,000. I have another client, the Smiths, who can use their second eligibility currently for $144,000 to $392,000. So it just depends on your income, your debt ratio, and the amount of disposable income or leftover income that you have each month. So it's calculations that we would work through to figure out what that second eligibility is. Don't be worried though, if you have a vet and they assume the loan, you reinstate your eligibility. It takes a week or two, and then you are fully eligible to go rebuy. If you do a simple assumption, you can still rebuy under second eligibility, as long as you haven't had a foreclosure or have had something happen where you have hindered that second eligibility. All right, I think that covers it in a nutshell, except there's something else I want to share. So let's say that you sell your home, you put it on the market for $350,000, and you get a buyer that says, and you say in your terms, your real estate, as a real estate agent, you put in the terms in the listing that says assumption available, VA to VA, 3% interest rate, and I think it was 2.75, right? And 25 years remaining. And so you get a buyer that says, we'll buy the house for $350,000, but the mortgage balance is only $300,000. So something has to happen to provide that seller with that other $50,000, right? So the options are one of three. Either the buyer brings in an extra $50,000 to the closing, and if they do that, then that closes that gap. The second option is they go find a second mortgage financing for $50,000 and see if they can secure a $50,000 mortgage loan behind that first assumption. Or number three, the seller provides secondary financing with some sort of land contract terms that your real estate company and your title company can put together, and it can actually be recorded with a mortgage and with a note so that it is documented and required, and they make payments to that seller. So those are the options that I can see on being able to assume loans. I think as the market continues to change and shift, and you have some of these shorter term loans that are left with great interest rates, it's important to know that every type of government loan can have an assumption. That's an FHA loan, a USDA Rural Development loan, and this VA loan. Thank you so much. I'm here to serve you and can answer any questions that you have. I'm licensed in multiple states and I'm based in Michigan. Thank you and have an amazing day.